It's been a really fascinating week for the UK and the US, two pieces of economic data which really highlight the differences between the two at this point in time, but also maybe give us an indication as to what's to come. We'll start with the US. The inflation data that we got on Tuesday seemed like a real turning point. Now, we've seen inflation in the US actually declining now for quite some time. But what we saw on Tuesday really felt like a big step in the right direction. Not only did we see a beat on the headline number, which fell to 3%, so really quite close now to the Fed's 2% target. But we also saw a beat on the core number as well, which dropped to 4.8%, and that was only expected to fall to 5%. So again, still well above the Fed's target, but moving in the right direction, and a beat on both the headline and the core numbers, which is something we haven't seen too often in the recent past. Also, on the monthly data, we saw 0.2% on both, which again was a beat of 0.3% that was expected. So broadly speaking, the markets very much cheered this data, and it did seem to come from some sustainable areas as well, things like used cars, rents, etc. These all contributed to the lower core inflation numbers, and that's going to come as some comfort to the Federal Reserve and be supportive as far as investors are concerned as well. Now markets are still heavily pricing in a rate hike from the Federal Reserve in 2 weeks' time, because it's something that's been heavily communicated. I think had the Fed not paused at the last meeting, I think a pause would be much more heavily priced in now. But I think the Fed is probably a little concerned to pause for a second consecutive meeting, as the signal it would send to the markets is that they are done. And I don't think they want to do that at this point in time. I think a rate hike now allows them plenty of time over the rest of the summer to collect data and make a more informed judgment, just as the data seems to be turning more favorably. Then we look at the UK, and we had GDP data this morning. And once again, what we saw was resilience. Resilience in the economy, resilience in the labour market that we've seen for quite some time has been quite evident. We have to remember that this time last year, it seemed inevitable that the UK would fall into recession. Everyone seemed to be of that view. All the forecasting agencies were saying that the UK would fall into recession. Of course, a lot happened towards the back end of last year, which is easy to forget now because it feels like such a long time ago. But the UK was facing immense difficulties. But we've seen incredible resilience over the course of 2023. And that was evident in the GDP data again this morning. 0.1% monthly contraction, better than the minus 0.3% GDP growth that was forecasted. And again, highlighting that the UK economy remains strong enough to avoid recessions at this point in time, but also to support things like inflationary pressures as we've seen over the course of this year, but also, broadly speaking, just stagnating, avoiding recession, but not really recording any growth either. Now, what this means from the Bank of England's perspective is that they are going to continue to have to proceed cautiously. We saw from labour market figures recently that we are seeing some signs of progress. Wages were stronger, but unemployment ticked up to 5%, another 0.2 percentage points. We are seeing people move more into the labour force again, returning either from retirement, or we're seeing higher levels of immigration, which are helping to offset some of those pressures as well, creating that a little bit of additional slack in the labour market, which should suppress wages over the course of the next 12 months. So we are seeing those pressures subside from those angles, not yet having the effect on wages, which is why the Bank of England is going to have to proceed with multiple more rate hikes yet. But again, that picture could start to look very different over the course of the next few months when we do see inflation inevitably subside as well, due to lower energy and food prices, among other things. As I say, that's a lot of information to take in over the course of the last week as far as the US and the UK are concerned. So what does that all mean for the pound-dollar pair? Well, we've seen some interesting developments here too. We've seen the pound breaking higher against the dollar, or continuing to break higher against the dollar. We've seen a strong run over the course of the last week. Not long ago, we were testing that rising trend line, bouncing higher off there, remaining above the 55-89-day simple moving average band. But what we've seen over the last 24 hours is a break above 130. Now, 130 has historically been a significant area of support and resistance. It's a big psychological move as well. Now, we'll have to wait and see if we see a close above here, both on a daily and weekly basis, but it is looking promising at this point in time. Also, on top of that, if we look at the momentum indicators at the bottom, they look to be confirming the price moves that we've seen over the course of the last couple of days. You can see that we're seeing the MACD histogram, the MACD moving averages, both trending higher alongside the price. And we're also seeing the stochastic maybe slightly flatlining, but around the peaks close to that 100 level. So we're not seeing a deterioration in momentum alongside that break of 130, which does suggest that may be sustainable. It's no guarantee. It's just a supportive factor. Now, there's two things we need to point out here. One is that we've broken through that 61.8 fib that you can see on the chart, the green 61.8 fib. We broke above that last week and we've held above there comfortably. Now, the reason why I highlight that is the Fibonacci that's referring to goes back to the highs of 2021 to the lows of 2022. So the break of that 61.8 fib does suggest that this is a longer term trend higher rather than a continuation pattern of a decline from those 2021 highs to the 2022 lows. So I do think that is also relatively significant. In terms of the key levels to watch from here on in, I think there's two that stand out. Now, you can't see these levels on this chart because if we did stretch the chart out further, then everything would look very small. But the key levels which stand out to me above here that we're looking at compared to previously is 132 and 133.50. So these were notable levels, important levels of support and resistance going back to 2020 and 2021. That's no guarantee that we'll see support and resistance around those levels again, but they were levels and areas of support and resistance that have stood out previously that may potentially stand out once more. But again, we will be keeping a close eye on those momentum indicators to see if it continues to confirm price action, if it does continue to trend higher, or if it potentially starts to signal weakness in the trend, which could potentially signal exhaustion after another strong run in this currency pair. But going forward, the focus remains clear. It's going to be on the economic data, but most importantly, that Fed meeting in 2 weeks' time. The inflation data may have come too late in the day to change the course of the conversation at that Fed meeting, to change the outcome of a Fed rate hike. Markets, as I say, heavily pricing that in at this stage, but it could very much have an impact on the language that the Fed uses, hints that it uses, and whether it takes a far more balanced approach to future rate hikes going forward. And that is going to be what we're going to be focused on. That's what the market's going to be focused on now over the course of the next 2 weeks.